Hello everyone, this is Dave, aka DREBG, senior member over at informedtrades.com. For those of you not familiar with Informed Trades, I welcome you to go over and take a look around. Everything is free, lots of great information, lots of great traders, and even a blog where you can post your own stuff and share your ideas. What we're looking at today is the Aussie dollar pair. This pair has been in an obvious uptrend for quite some time, and I think it's finally time to really think about taking a short. And I'm going to try and express why I felt that way, and also allow you to see exactly how it was that I came to that conclusion by showing you how I mark up my charts and where I think the trade might go. So the first thing we do is put in some basic indicators. In this case, everyone knows I'm a big fan of the 200 EMA and the 20 EMA. But we also need to zoom out a little bit so we can put in some support and resistance lines and maybe some trend lines to get a better picture of where this pair has been going. Right off the bat, from a weekly perspective, I think it's plain that this pair has been in an uptrend. If we put a trend line in here, it gives us an idea of where price action may break through to have some sort of a retracement before we can actually determine which direction this is going to either continue in or actually go the other way. Now, what's always super important is to put in some support and resistance areas. I like to do it on a weekly and daily time frame to give us a better perspective, and when we put those in, you'll see that there's some pretty key areas in here that are important to note. Of course, way down at the bottom is the 94 handle. Just above that is going to be the 98 handle, the 102, 106, and 108. All those areas are pretty solid touches from a price action perspective. You can see we have some touches here, here, and here. And you can see there's some consolidation here. And again, on the shorter time frames, you'll see this better when we go back down and check those out. So back down to our daily chart, one thing that really struck my fancy was the recent run-up that we had here. That channel looks like this. Now, some people may say, well, you didn't draw this at the end on the shadows and you could draw it differently. I think this is most representative where most of the price action is, and it's going to be more telling than most as far as drawing where this channel should or shouldn't be, at least in my view. Now, some of you Sam Seiden fans might see a supply area in here that just broke. This blue area has had some really great supply areas that would have been great areas to short, but as you can see, it broke that area, and this 108 handle really seems to be holding fast. This was more for an observation. The fact that it broke is really of no consequence, and I'd like to put it in there simply because I like people to see that even major supply or demand areas fail, and you have to be ready to trade those and lose accordingly. Adding some credence to why I think there's a reversal coming in is this fib expansion that I'm going to put in. Here we are as A, B, C, and the 100% expansion would be here, but we're at the 127. That 127 is actually a 127% expansion of this move from C to B, and you can see that we're coming right around that resistance area at 108, which adds credence to the fact that this could be starting to finally lose some steam. Now, once I do these studies, I tend to take them out and just mark the areas that are important. In this case, we determined that the 127 expansion area was important, so I'm just going to take that out and leave a mark in there indicating that that's where that was. Next thing we'll do is a Fibonacci retracement study of the last up move in the channel. This channel lets us know that we have this run up, we have some resistance, and now we're looking for some sort of a pullback. And if a pullback were to happen, where would it go before it either continued or continued back down? Well, in this case, the 38.2 fib is here, the 618 is here, right around some resistance here at the 102 level, and approaching this long-term trend line as well. So those are two areas I'd like to mark off, and that way we can get rid of the fib study. Again, I like to keep the charts as clean as possible, but also have as much important data on there that we need to make our determination of what trade we might want to take. Now, I really think that getting down to the 382 is a no-brainer here in the next week or so, maybe 2 weeks, I don't know. But if that's the case, is there anything else in this area that we could identify that may help bolster our position that this would be a good place for price action to get to before doing something else? I think you could make a subset of resistance here, or support in this case, right there at the 104.60 level, and that comes in right around that 382 level. You can see we have some touches here and here, all the way back here. That goes all the way back to the beginning of January, or the end of January, I'm sorry. So that's the basic framework we're going to work with. But now we have to really determine, okay, if this really looks like it might be a short, where do we get in and how do we determine the best timing to do so? Personally, this daily chart I see as breaking through this bottom channel, retesting the bottom, and then now coming back down. This is where I think price action is going to go. So let's go down to a 4-hour chart and see if we can make some determinations. As you can see, in my analysis, I have my channel drawn here, but some people might say, well, you know, technically this might be the bottom of the channel if we drew it differently on the shadows, and it hasn't broken at all. Yeah, that's a possibility. I'll buy that, but I really have a thing about drawing my trend lines and channels where most of the price action occurs, and that's going to be not necessarily at the end of the shadows, but where the pricing closes or opens. In this case, obviously the close or open of each one of these candles. Okay, so we think price is going to go down. Where do we think it's going to go, at least initially? Well, we said maybe that 382 or that 618 level, but if we draw a fib expansion from the price action just recently going downwards, we have some more confluence here of a 1618 retracement down around that 382 level from the fib that we did from the entire move up. That's a good thing to mark off. So again, I'm going to remove this, but then mark off the spot where I think a lot of the support will come in at, and that's that yellow rectangle that you see. When we zoom back out to the 1 day, we'll leave that in there, and we'll see that although this may be a little bit steep, it's going to be somewhere around this area where we want price action to come in at, and then make a determination then of whether we stay short or get out and re-enter when it retraces a little bit higher. Who knows? Maybe get out altogether and the trade's over. But we're just trying to make some determination of not only when to get in, but when to get out. Now, I purposely didn't put in pivots. Everyone knows, who's heard me do these before, that I'm a big fan of weekly and monthly pivots. But I purposely didn't put them in this time simply to identify the fact that you can make a framework just by looking at price action and drawing a few lines in. Given that, I think once I put the monthly and weekly pivots in here, you're going to notice something very, very interesting. When I put them up, you're going to start to see that the monthly pivot is right around the level that we've already identified as a pretty solid level where price action is either going to pause and reverse back up or at least get to before something big happens. When we put the weekly in, these are just smaller hash marks. We have the weekly pivot here. We have S1, WS1, WS2, WS3 is down here, not far again from this area of confluence. Now we're really starting to see that this can be a solid area that price action should probably get to before it's going to do anything much bigger. So there it is. We think price action is going to go down. We're identifying where we think the first pause is going to be, and that's going to be right around that 104.60 to 105 area in here. But where do we get in? Well, if we zoom down to an hour and we look at what price action has been doing, now we can start to determine the best area that we think we can get into our trade. Well, a fib expansion study on this most recent drop yields some telling information where we have this A, B, C, D, and then it blew right through and went all the way to the 1618 before retracing back up. This tells me that we've made the first move and we're actually in a pretty good position for a high reward, low risk trade. Well, what about other indicators? There's nothing else up here. What are some other things saying? Well, I'm going to throw a MACD up here on a daily chart. We're back up to the daily. We have a nice cross here on the MACD down. This hasn't happened, folks, since the end of December when we had a cross back up. And I think this is very telling when you add this to the confluence of breaking a channel, the resistance that we see up here, not to mention the histogram divergence that we have on MACD down here, and of course price action going up there. Lots of confluence is what we'd like to look for. So we know where MACD is. Let's get rid of that. We're left with our framework. Now, where do we get in? Well, one school of thought is to be conservative and enter a sell stop order below this swing so that the market takes you in. That would be at 106.35. That's a conservative entry. The problem is if we have our goal down here, our target, and we want to put our stop loss above this swing, that's a 1-to-1 ratio, which isn't horrible, but I usually like to see our risk to reward ratios a little better than that. So that means the other option is to enter now, or just above where we are now, and I'm saying somewhere around 107.50 would not be a bad entry at all. That gives us better risk to reward. Our stop can still be above that swing high, as well as weekly R1 and monthly R1. That's not a bad place at all, and I like that entry a little bit better. In fact, after I made these screenshots earlier this morning, I actually took this trade, and I'm short from right around 107.50. So from there, I'll follow this on my blog. I'll update it as we go through. But the real point that I'm trying to make here is that when you come across a chart that's just blank, and you start to add things, and you start to realize that there's a framework involved, and there's an analysis that's involved, and there's some actual work that you might have to do. It's not just about putting up the most recent indicator and having it tell you exactly which direction things are going to go. When you go through the whole scenario like I'm doing here, and you come out on the other end where you've done a great job of analyzing, you've done everything you can to identify those areas that are solid, you're left with a really solid trade. And if you do this enough times, you're going to come out ahead. You just have to make sure you keep your stop losses in place and make sure that you do the analysis and don't just hop in, because it's when you stop doing the analysis and stop doing the work that it takes to truly get this done right, when you start hopping in on things that are not right, not the right time, didn't do enough analysis, there's some news event you didn't count on that you didn't even look at, too many variables that you could have filtered out but just decided not to. This is the type of work that it takes to be a trader, and that's why so many people fail. So with that, good trading. Let me know what you think. Thanks.